this is the story that you haven't been told. And let's just say, surprise, surprise, it's all the government's fault. Not only did they lead to this massive expansion through easy money policies with the Fed, through this massive credit expansion and the war, not only did they lead to the boom, then they caused the bust by pulling the punch bowl back, right? The vast money, the vast credit expansion by the Coolidge administration, which was there before FDR, led to this inflation, right? But it was the pulling the back that led to the crash. But again, why did it go from just a little crash into this long crash? And it's partly because of what was deemed this New Deal, or the new economics of government planning. The world economy was disintegrating at the same time. So it wasn't just the U.S., it was sort of the whole world going through this at the same time, moving into this new socialist environment, this new government expansion. And so at the time, the president urged businessmen not to cut prices and reduce wages, but rather to increase capital outlays, to spend more. He said if we could maintain purchasing power. And so then they embarked on deficit spending money they didn't have. They called on municipalities to increase their borrowing for more public works through the farm board, right? And let's just spend more, we'll spend our way out of it. And then things got really bad. Under what's called the Smoot-Hawley Tariff Act in June of 1930, what they did is they raised American tariffs to unprecedented levels, which basically closed off borders of foreign goods. All right. Now, according to most economic historians, this was the crowning folly of this whole period from 1920 to 1933. And this is really the beginning of the real depression. Because once we raised our tariffs, then we saw protectionism run wild all over the world. Markets began being cut off. Trade lines with other nations were shut down. Unemployment in the export industries all over the world grew. Then President Hoover said he would sign the bill into law, and then industrial stocks broke down again. The market kept crashing. The more the government tried to meddle, the more they tried to protect, the worse things got. The protectionists, they never learned that curtailment of imports inevitably hampers exports. So when we don't import as much, then we don't export as much. Agricultural commodity prices, which had been well above the 1926 base before the crisis, dropped to a low of 47 in the summer of 1932. As that happened, then farms started to go under. Farm mortgages started to be foreclosed upon. And in order to start to sort of stem the tide of that, they passed more laws to now ban or pass moratoriums where they couldn't foreclose on properties, sort of like 2020, when they said they couldn't foreclose on homes or evict people. Then that shifted the bankruptcy to the creditors. So instead of the farms going bankrupt, then it was the creditors that went bankrupt. And then that caused a banking crisis. The main creditors of the American farms were, of course, the rural banks. When agriculture collapsed, the banks closed their doors. 2,000 banks closed their doors because they had deposit liabilities of $1.5 billion, which they had to suspend between 1931 and 1932. 1931 was a tragic year for the whole nation, and really into the world, because the whole world sort of started to fall into this despair and depression. The whole world is connected. So when you start to cut off supplies through imports and exports, everybody starts to get affected by this. In America, as we already talked about, unemployment went through the roof. More than 8 million people were unemployed. And so then President Hoover, who was still there, called together the nation's industrial leaders and pledged to adopt his programs to maintain wage rates, expand spending, and for federal agencies to do what's called price stabilization policies, or price fixing, if you will. And that would be to generate larger crops and surpluses. The problem is when they artificially did that, then it depressed prices, because when you have more supply than demand, prices go down. So when they depressed prices because they oversupplied, then economic conditions got even worse. As a matter of fact, they went from bad to worse. And then unemployment shot up again in 1932. And then when things couldn't get any worse, we've gone a couple years of this. The government just can't get out of the way. They just keep making things worse and worse and worse. They did it again, and they struck a final blow in the Revenue Act of 1932, which doubled the income tax. It was the sharpest increase in federal tax burden in American history. So you have people can't even afford to live. Everything's crashed. It's been a couple years now. Through meddling in the markets with the farmers and whatnot, they've crushed the prices. The farmers are going broke. They can't evict them. Now the banks are going broke. Everyone's going broke. The unemployment has, gone up by 10 times. And then when everybody's down in the dirt, they kick them by doubling the income tax, the highest rate increase in American history. Murray Rothbard, in his book America's Great Depression, estimates that the fiscal burden of federal, state, and local governments doubled during the period, rising from 16% of net private product to 29%. So when the government takes double the amount of money they're taking from you, what do you think is going to happen? You have less money to spend on other things. Then came FDR. Then FDR took the presidency. He also fought the economy all the way. His first 100 days, he launched all these these agencies. He struck in every way at the integrity of the U.S. dollar, including he seized everyone's gold. And not only did he seize everyone's gold, which he gave them dollars for, paper dollars, but then he turned around and devalued those dollars by 40%. So now people are even more broke. Not only did they double the income tax, they're already broke, they doubled their income tax, and then he took half their money from them. That's a double whammy. Double the tax and take half your money, 40% of your money. Then again, then he passed what's known as the Reemployment Agreement and basically put in a minimum wage of 40 cents an hour. It wasn't a lot, but he put in a minimum wage. But when he put that into place, then the unemployment rose to nearly 13 million because now they couldn't hire people for less. So they just hired less people. That's what happened. Then he tried to pass this Farm Relief Act. He wanted to raise farm prices by cutting the acreages planted or basically destroy the crops in the field. So then he literally paid farmers to not plant. Literally paid them to not plant. Before they planted too much, the supply brought the prices down too low. This time they said, here's a better deal. Instead of increasing supply, let's cut the supply. So now we'll pay people not to plant. But when they did that, guess what happened? Then the prices of everything went sky high and no one could afford it. No one could afford crops. They couldn't afford cereal. They couldn't afford meat. They couldn't afford any of that. Then on top of that, all of these empty fields that weren't being planted led to giant dust bowls, which caused even more destruction of plants or crops. So it's like, can you see? Every single time the government does something to try to help, they have unintended consequences. It sounds good, right? Hey, if we want to get prices of crops to go up, let's just cut the supply. Sounds good, except for all the unintended consequences we didn't think about. When the economic planners saw their plans going wrong, then they prescribed additional doses of the federal stimulus, right? If our plans don't work, let's just do more of them, so to speak. That's always the plan, isn't it?